Capital flight to foreign countries. Capital flight is an economic phenomenon in which assets and money are suddenly or gradually transferred in large scale from one country to others. This movement often occurs due to concerns about the economic or political future of the home country, in pursuit of greater security or higher profit. What is capital flight? Capital flight is the rapid and massive exodus of financial or physical assets, such as cash, stocks, bonds, and real estate by a country's residents to external locations. This outflow typically involves private money and not official government capital outflow or foreign direct investment (FDI). Key feature: capital flight is often considered unproductive, meaning, instead of being invested in the home country's production, employment, or infrastructure, it is moved abroad for storage or speculation. Main causes of capital flight. Capital flight is almost always a reaction to internal risks in the home country. The most important driving factors include political and economic uncertainty, political instability, fear of war, internal unrest, or sudden and radical changes in governance. Expropriation risk, concern over the nationalization of private assets or government actions to seize wealth from the rich. Lack of legal transparency, ambiguity in laws regarding ownership, contracts, and business regulations. Monetary and financial factors, high inflation and currency devaluation. When people fear that the value of their national currency will rapidly erode, they convert their assets into stronger foreign currencies. Low interest rates and returns. If domestic investment opportunities do not yield sufficient profits, capital is moved to foreign markets with higher returns. Currency controls. Government attempts to strictly control the exchange rate often lead to capital flowing out through unofficial channels. Tax pressures. High taxes. The existence of high tax rates on income, wealth, or inheritance encourages investors to transfer assets to tax havens. Negative consequences of capital flight. Capital flight is a destructive phenomenon that weakens the home country's economy in several ways. Reduced investment and growth. The capital needed for productive growth, establishing factories, and developing infrastructure is lost, leading to a decrease in the economic growth rate. Increased unemployment. With the reduction of productive investments, new job opportunities are not created, and the unemployment rate rises. Weakening of the national currency. Massive capital outflow means an increased demand for foreign currency and a supply of the national currency, leading to a severe and continuous devaluation of the currency. Reduction in the tax base. Capital flight is often accompanied by tax evasion, resulting in decreased government revenue and a reduced ability to provide public services. Foreign debt. To compensate for the shortage of domestic capital, governments or companies are forced to borrow from foreign sources, which increases the country's future debt obligations.